Good evening, ladies and gentlemen. Divya here. It gives us immense pleasure to welcome all of you to the webinar on FX options, optimal hedging alternative that's organized by NSE, National Stock Exchange of India Limited. NSE has always been on the forefront of empowering and educating the investor. We aim at cultivating a culture of knowledge to help the investors taking informed decisions. The objective is behind it is to equip the existing and the potential investors with the knowledge and understanding of the financial markets. So to take it forward here, I would like to introduce and invite Mr. Hari K to give the opening remarks. Hari sir is the Chief Business Officer at NSE, India's premier boss for trading equities, currencies, and their derivatives. Sir has been with the NSE for almost since inception for about 28 years now. He heads the business development across the products at exchange. That's equity, equity derivatives, currency and commodities, derivatives, fixed income, and NSE listing businesses. He is also overseeing the BD of NSE IFSC at the GIFT City. He was associated with the clearing corporation of NSE initially and was also involved in capital market and surveillance operations. He was a part of the team that introduced derivatives in Indian capital market. Sir was heading the listing for over a decade at NSE. I would like to invite Hari sir to do the opening remarks.
Thank you, Divya. So my speech will be less than the opening remarks, your introduction. Thank you. So good evening to all of you. It's good to have you all virtually connected in this program for FX options. Options is, why specifically FX options is India, we started trading in currency derivatives in the late, 2008, 2009. Currency derivatives started with futures, and then we introduced options. We started with USD INR, then we introduced other currency pairs also. So over a period of time, USD INR has been the most popularly traded FX pair. As you know that it's not only traded in India, it's traded in US, it's traded in Singapore, it's traded in Dubai, it's traded in Korea, and it's traded in many other jurisdictions. So USD INR is a very maybe attractive or very important currency pair which many people at many jurisdictions trade. So while most of them trade futures, and if you see the growth in the futures market, we have been growing about 70%. Even this year compared to last year, on an average turnover of about 30,000 crores on a daily basis. India is a market where we have all kind of players. We have the corporates like you who are trading, or we have the normal day traders. We have the high frequency traders who trade. There are the retail investors who trade. So there are various kinds of and the proprietary traders also trade. Banks and institutions also trade. So this kind of a mix of people who trade in the market makes it very, very vibrant, very attractive, very liquid, and that's why NSE has got about 70% market share in the FX futures segment. So while we spoke about futures, we also thought it's important for corporates like you to know about options. Options, this year is compared to last year has grown about more than 125%. FX options, especially USD INR, are very liquid. So just to give a perspective, India, NSE is the largest derivatives exchange in the world for the third year running, by FIA, rated by FIA. So that is basically because of our heavy volumes on the equities and equity derivatives on the option side. Now, we want to translate that into the FX options also, because as a product, options is a product which is meant for hedging. My colleague will tell you some strategies, will talk about more on detail on how to hedge using options. And it's been very effective. That's what people have told. That's what people have been using it as a tool. So corporates like you who have got phenomenal exposure in the market, we want to introduce, if you don't know to introduce, if you know to tell you more about it on options, especially on the USD INR pair, which will help you to take some informed decisions. So that's why we have this program focused specifically on options. And and when you go into options, there are people think it's complex, but it's not as complex as you think. We will try and make it as simple as possible for you. And there is decent volumes in options. In fact, we have grown phenomenally in the options. Our premium turnover, that's what we normally call, the premium turnover is about 100 crores on an average. The notional turnover is about 35,000 crores on a daily basis. So it's a market which is liquid. I'm sure all of you will find it useful. I don't want to spend more time on introduction. I want to give this floor to my colleague who will be able to give you more insights on how to trade FX options, how to make it more attractive. Feel free to reach out to us after the program. We can do some specific trainings for your teams as well if needed. Thank you very much and best wishes. Thank you, Divya. Over to you.
Thank you, Hari sir, for giving us a brief detail on FX options on exchange, NSE. Now I would like to introduce and invite Mr. Hitesh Sethia, Chief Manager in Business Development Team at NSE, having a total experience of around 15 years in commodity and financial industry and having worked with various domestic and international exchanges in the past. He's a postgraduate in finance and holds various certifications in the field of finance. His area of interest are risk management, strategy development, and strategic business development. Here, I would like to invite Hitesh to share his experiences on various topics related to FX options and the risks associated with it, and take the presentation forward.
Thank you, Divya. Thank you, Hari sir, for setting up the context for options, specifically for corporates. Very good afternoon to all of you. I've been well introduced by Divya, and I'll be with you for next 60 minutes. And the focus of today's discussion will be options, or options from a perspective of its usage for corporates. So when we move around, when we talk to market participants like corporates like you, people who are listening to me, from years, they are using linear products for hedging. The classic example are forwards in the OTC markets and futures on the exchange traded segments. However, the non-linear derivative, specifically the exchange traded and non-linear derivative product, which is options, is far more important, and it actually comes with a lot of leverage to the corporates. Leverage in terms of the money being deployed, leverage in terms of monitoring it, and a lot of other perspective of leverage are also associated. So my perspective of today's discussion is specifically focused towards defining when and how to use options, and with a specific reference to hedge your underlying exposure. So I'm going to share my screen now and we'll start my presentation. We'll start with a little basic, which includes what exactly the contract specification for a few minutes, the difference between futures and options on the position side. Okay, on the position side. We'll move on further on how to replace futures trading with options. It becomes more effective when you start using options instead of futures, right? We'll use some Excel to explain you things with more with numbers. Okay, then we'll move on to the kind of strategies, the combinations of options can be used for optimal hedging. And towards the end of the presentation, we'll have a detailed Q&A as well on it. So this is what today's agenda for discussion. I believe my screen is visible to all of you. Let me start the day. So what is in front of you? Few minutes on the options contract specification per se. Today, though, we are going to focus on USD INR options, but there are a range of option products which are being available. Okay, starting from USD INR, the four currency pairs which are based on INR, and 4 currency pairs which are cross currency pairs. Those are also being available. Okay, the tick size is being given, the time, the contract cycle, but the best part which I want to highlight out here, is weekly options contract. Okay, so if you are exposed for a risk which is of 5 days, 10 days, 15 days kind of, okay, you can use options. So it is just not about using options for 2 months or 3 months position for managing or hedging your positions, I mean to say, but weekly options also gives you an opportunity, okay, to hedge your underlying exposure for a small period. And this is, trust me, this is extremely effective per se. Okay, the initial margins on short side of options are applicable, I mean to say. The daily settlement happens, we all understand. The final settlement happens on E+2 basis. The final settlement rate is FBIL's reference rate per se, the RBI reference rate, which is now being, published by FBIL. And the mode of settlement for options are cash. Okay, because it is cash settled, it gives a lot of leverage at the time of hedging. Okay, so you can continue with your exposure in physical markets, hedge your risk, and no need to worry about anything as it is going to be settled in cash. Okay, so almost same futures practices are being adopted in terms of clearing and settlement out here. But 2 important things in futures: when you buy futures, that is when you long a futures contract or when you short a futures contract, you are exposed for giving margins. So you have to give margins to the against your exposure. But in case of options, when you buy an options contract, the outflow which happens from your side is the amount of premium. That's it. Okay, which is far less than the amount of margins being blocked on the futures. And if you are going short on the future on the options contract, right, in that case your exposure is towards margins. Okay, so a thin line difference between futures and options in terms of amount, the margin, the premium, or the amount which is required for creating positions. Number one, futures, whether long, short, you need margins. For options, if you're going long, right, okay, only a certain percentage of the contract value, which is defined as in premium, will be applicable on you. Wherein, if you're going short option position, creating short option position, okay, you are exposed for margins. Okay, this further gives you a leverage that you can even move on towards buying options contract. Okay, a bit about options, just to set up further context what Hari sir has said, started with. Options are really quite less risky from a holder perspective. A holder is nothing but the person who buys an options contract. Option writing, because it is equally important to understand the option writing perspective. Option writing is nothing but a technical word which is used when someone creates a short option position, could be in call or could be in put. It works best with non-directional products. So let me give you a context with this. So when you want to play, sorry, I'm using a word play in the hedging program, which is not appropriate, but just to give you a context to it. When you want to play on direction, right, could be bullish, could be bearish, okay, using futures, right, is one of the best perspectives. But when you want to, when you really want to be very neutral, you don't want to judge anything, right, you are not inclined towards finding out what is expected to happen. When you're working with a non-directional side of markets, option works best. Which side of option? It is called as option writing works best for you. Options are definitely more leverage from holder perspective. With small premium amount, you can have a position per se. It is more flexible. Why? Because you have series of strike prices. You have weekly options contract, you have monthly options contract, you have call option, you have put option, you have series of strike prices, you have in the money options contract, at the money options contract, out of money options contract. So you have, the name itself is options. It gives you an understanding that it is full of options. It is full of options. Okay, so it gives you more flexibility that out of several strikes, you can select appropriate strikes. Okay, and you can even manage the outflow as an option buyer. We'll understand during the course. Definitely, when you're exposed towards futures, see, I'm not saying that futures are not good, right? But you should understand when to use futures, when to use options. That's what the essence of this discussion is. When you're using futures, you're exposed for mark to markets. But if you're using option, from buyer's perspective, from holder perspective, you're not exposed for it. And yes, floor and ceiling prices can be created with the help of options. You can lock in your buying price, you can lock in your selling prices with the help of options. Okay, you can plan the entire exposure with the help of options. Okay, so it is important to discuss futures one by one. We'll take conditions, we'll understand each and every condition, right? And we'll combine this with the options perspective. So the first example, what is now in front of you, is the hedge example of long futures. Let me not read this completely, but let me tell you, as an importer, right? As an importer, someone hedges his position using long futures at 75. Okay, right? That means he buys a contract at 75. Okay, okay. The value of the contract will be determined as 75 multiplied with lot size, right? Multiplied with his exposure. Okay, for this he has to pay margins. Long futures attract margin amount, right? That is supposed being paid. Now let's examine two scenarios. He carries out, he continues his position from the day when he created till expiration date. On expiration date, suppose there are two scenarios which are being put up in front of you. Scenario one talks about FBL rate, which is the final settlement rate, is 77, and the scenario 2 talks about 73 as an FBL rate, right? 75 is the exchange rate at which the importer has initially hedged his position by going long in futures contract. Okay, we all know if something has been made long at 75, right, and the FBL rate comes at 77, right, he will make money out there from futures contract. And this money being made from futures contract will help him to compensate his outflow as an importer when he's making the payments. Okay, same way, if the FBL rate comes to 73, he loses money. He loses money in the futures. But at the time of making his payments, okay, he adjusts that 2 lakh rupees. And finally, his effective rate, what is the most important part out here on the slide, is on the right hand side, the last line. The last line talks about the effective rate of hedging is the rate at which he has hedged his position initially. So if he has hedged at 75, technically he has locked in. He has locked in his import payments to be done on the date of expiration of the contract at 75. Okay, so once hedged, that means hedged. Okay, right? This is just an example. You can have a look at it. Being a linear product, anything going above 75, anything going below 75 is defined on the right hand side as an payoff diagram. Payoff diagram. Okay, right? And the column which is being put up out here, the column which is being put up out here, which is effective rate of hedging across scenarios. If you see across scenarios out here, okay, the effective rate of hedging is 75. So whether the exchange rate goes down to 70, goes up to 80, irrespective of it, the effective rate of hedging will be 75. Now let's compare this, that instead of futures, if the importer executes a long call options contract, number one, for doing this, he has to select a specific strike price. So in my example, I am taking up at the money options contract, same, though I understand 80, the exchange rate is prevailing close to 80. Current at the money is 80, but in my example, deliberately, I'm taking up 75. Okay, these are illustration, these are example, just to communicate the right approach per se. Right? So 75 is the ATM. We have selected that. For every single contract which he buys, the long call options contract, he has to pay a premium. So I'm considering premium of 50 paisa for the month. Okay, 50 paisa is the amount of premium. So the required exposure, as per his required exposure, the premium payment comes to 50,000 bucks. The premium payment comes to 50,000 bucks for him. Okay, so he has bought a call. Now, buying a call very, very theoretically says he has made a promise that he may buy USDs. He may buy USDs at 75, right? He may buy USDs at 75. Though we all know it is cash settled contract, so it is going to settle in case no one is going to get USDs or something, right? Okay, it is just a cash settled contract, but technically it means he has locked in his price to buy USDs at 75 by paying a premium of 50 paisa per se. Okay, these are different scenarios, and would like to explain few scenarios of this table to all of you. On the right hand side, you can see a net payoff diagram, but it is important to understand the prospective effective rate of hedging. So as an importer, he had some commitments to make payments, and against his commitment, he has bought a long call options contract, right? 75, 50 paisa premium, right? So let me directly explain you the effective rate of hedging, how it is going to work for. Okay, suppose the volatility comes up and the final day settlement price, the exchange rate, I mean to say, comes to 79. He has used 75 as in strike price. Okay, but the final day, I'm taking an extreme scenario, 79. Okay, right? Okay, he is going to make profits out of his long call position, which are being defined out here. Definitely strike price minus premium after final settlement price minus strike price after adjusting premium. Okay, will be his profit coming from the long call position. Okay, and because he has to make payments, right? He has to make payments against his imports, which he makes it, right? Which brings his effective price of hedging to 75.5. So the final price after making the payment, okay, so he hedges his position, squares off his position, or remains his position open. He gets profit from the call option side. Okay, he makes the payment against his import by dealing with the bank, right? The final effective price comes to 75.5. Now, what is 75.5? The strike price plus premium is his maximum effective price of hedging. Market, the maximum effective price of hedging will be 75.5. Whereas, now please mark it, okay? Whereas if the exchange rate goes down to 71, okay, INR appreciates, okay, if it goes down to 71, okay, he loses money on his hedge position on the call side, okay, but it's effective rate of hedging. Effective rate of hedging means he make the payment, he makes his payments against his import. Okay, his final effective rate of hedging comes to 71.5. Okay, why? Because the spot USD and INR rate is 71. Okay, so he has to shell out money based on the effective rate per se, which is 71. So he has to buy USDs, remit those USDs against his import payment at 71. His outflow will be 71 plus the amount of loss which he has got from the options. Now, this is not appropriate to call it as in loss, because ultimately by doing this, by hedging, by paying a small cost as in premium, his effective rate of hedging from 75 comes down to 71.5, comes down to 71.5. Okay, so across all scenarios, if you see, right, across all these 10, 11 scenarios which I have made, if you see, right, a cap, right, is of 75.5. Okay, and if the exchange rates goes down, that means if INR starts appreciating, it goes to further lower levels per se. So it becomes so effective that if you are holding a call option, okay, as an importer, it becomes so effective that it helps you to improvise more on your profitability margins, okay, along with hedge positions. Okay, a little difference being put up in the table, that instead of long futures, if you're doing a long call, right, in long futures you need margins, but if you're doing long call you need premiums. That's it, no margins required basically. As far as effective rate of hedging, right, if you're using futures, the price at which you have hedged your future is the effective rate. But in case of long call option, it is strike price plus premium, that is a cap per se. Effective rate of hedging, if the exchange rate goes down, okay, out here, the exchange rate at which the futures contract is hedged, number one, for long futures, okay, so no change practically. But for long call, we have just seen it becomes more and more effective. The effective rate of hedging keeps reducing. So your effective rate of hedging starts reducing if the spot price, which is nothing but the exchange rate, becomes bearish, which helps in reducing the cost of outward remittance. So there are a lot of advantages to it. Okay, but let's explore further. Okay, this is the example of short futures. Let me little fast run through it. Okay, we have a lot to cover per se. Short futures, as an exporter, you're doing it, let's say a short futures contract. Short futures, that means again you have locked in your price, right? You have locked in your prices. Exchange rate you have practically locked in. The price at which your transaction gets executed is the final price of execution. Okay, right? That means you have made a commitment that at this exchange rate, I hedge my position. That's it. Okay, right? You can see this out here. Various rates on expiration date has been taken up. You can see this out here, and a lot of and all of them talks about effective rate of hedging is 75. Okay, but instead of this, if you have executed a long put options contract, from the exporter's perspective, if you have executed it, to buy a put, to go long in the put option, okay, you have to pay a premium. I'm considering 50 paisa premium out here. Okay, and let's understand how the effective rate of hedging works out here. As an exporter, you have bought a put options contract, paid a premium of 50 paisa. Okay, if on the date of expiration, okay, exchange rate is 70. If the exchange rate is 70, okay, you're going to receive USDs from your counterpart. Okay, and you also have a position out here on the exchange. Okay, so you're going to, if the exchange rate is 70, you're going to receive your payments. Okay, at the prevailing exchange rate in the bank account. Okay, but because you have bought a put options contract, okay, and that put options contract becomes profitable. Okay, why? Because you have selected a strike price of 75, paid a premium of 50 paisa. It brings your effective rate down to 74.5. It brings your effective rate of hedging down to 74.5. So irrespective at whatever will be the exchange rate, okay, right, 74.5 is constant. You can just have a look at it, 74.5 out here. But if INR starts depreciating, okay, your effective rate of hedging becomes more lucrative. Effective rate of hedging, it becomes really more lucrative for all. Okay, have a look at it. If it becomes 79, 80, whatever it is, okay, your effective rate starts increasing, right? That means in your books, the final realization starts increasing. The effective rate of hedging means what? Ultimately, as an exporter, you start realizing more. And that's what the overall objective. Okay, right? So you are hedged. Okay, you pay a premium with options, whether it is call, whether it is put. Okay, your effective rate of hedging is floored at strike price minus premium amount. But if the exchange rate starts becoming bullish, okay, right, that means INR starts depreciating, then the amount realized will increase the final realization in your books of accounts. As an exporter, your final realization increases, right, with the use of put option. Okay, This is how uh, uh, market players, corporates who are already using options, they use options with an objective to improvise on their effective rate of hedging. Okay, with futures, no, once blocked in is blocked in. Okay, again, with a table trying to explain the difference between short futures and long put options, margins with futures, premium amount with put options. What if exchange rate goes up? What if when the exchange rate goes down? Both scenarios are being covered. You can just have a look at it. The effective rate of hedge position will keep increasing. Effective rate will keep increasing if exchange rate becomes bullish, which helps in leveraging the inward remittance, the payments what you're getting finally in your bank. Okay. However, we are discussing so far about buying an options contract, but we should also understand that what are both sides of it, the pros and the cons. I've just explained you how to use it, the pros, when you combine it with your underlying exposure. But it is my duty to explain you, when you buy an options contract, when you buy a simple options contract, what is your probability to win? I'm not combining this with your underlying exposure, but just to understand, just to give you a context to it, that if you just buy a call option contract, what is your probability to win just in options? Okay, not combining, again telling you, not combining it with the underlying exposure. Okay, have a look at it. Suppose the exchange rate has moved like this, right? And I've marked a red dot out here, which says the current exchange rate is out here. At this exchange rate, suppose it is 75, you buy an options contract. Which options contract? You're buying a call options contract by paying a premium. Now, there could be 5 scenarios. This will further build your understanding towards options, right? About winning probabilities per se. Okay. Suppose the exchange rate becomes bullish, that means INR starts immediately depreciating. Okay, right? In that case, I have given it as a name, that case 1, the exchange rate goes up, right? Straight away up with a lot of strength, with a lot of velocity, the exchange rate goes up. That means INR starts steeply depreciating. Okay, case 2 is that exchange rate starts depreciating, but with a lower pace per se, not too fast, lower pace. Okay, that is my case 2 out here. Okay, case 3 is that exchange rate goes into consolidation. A consolidation is like, the exchange rate is just moving in few paisas, right? Neither going upward nor going down. Okay, the fourth case out here, which may happen, which can happen, whatever. Okay, is exchange rate going down, but with a lower pace. That means INR starts appreciating out here, but with a lower pace. Okay, and fifth case out here, which has been put up out here, as in straight away INR starts appreciating. That means exchange rate becomes bearish. Okay, 5 scenarios. So the minute you buy a call option, right, any of the scenario can happen. Right? Any of the scenario, case 1, case 2, scenario 1, scenario 2, 3, 4, or 5. Okay. Now, because you have bought a call option and case 1 happens, the scenario 1 happens, right? Your call option position will start yielding you a good amount, right? Number 1, right? So you will be a winner in the call option side. Number 2, that INR starts depreciating. Okay, the exchange rate starts moving in the upward direction with a lower pace, right? Lower pace. Still, you will be a winner, or I have put in may be a winner, but yes, you will be a winner, right? That means your call option position, right, will either take you to a break even or with some profits per se. Just call option position. If it becomes consolidation, right, a very smart consolidation starts happening, in that case your call option position starts giving you losses out here. Case 4, loss. Definitely you buy a call option, the exchange rate goes down, INR starts appreciating, you're not happy with. In case 5, again, you lost. So what I'm trying to say out here is, when you buy a naked call option, right, you have a winning probability of 40%. Out of 5 scenarios, you have a winning probability of 40% only. You have a losing probability, which I have not put in, but you have to understand this perspective. Why this slide? Why this slide I have deliberately kept out here, right? Because when you want to use option, you should have a strong and a thorough understanding that when you should buy a call option, right? Or when you should buy an options, not just limited to call. When you should buy a call option and when you should avoid buying a call option. Avoid buying a call option. So if you have an expectation of scenario 1, scenario 2, with some, some news data information being released, expected to being released, okay, some change in interest rate, some further change in policies, in such cases, okay, a naked call option is a right alternative, right? Else we have to look out for the other side of option, which is called as short option positions. Let me repeat, short option positions. Okay, now to combine both and to arrive on a right doable thing with option, doable strategy with option, we are now starting up. So what is now in front of you is a quick cost comparison wherein I have not included brokerages, where brokerage is not being included, right? If you trade 100 lots, okay, of USD INR currency options on the National Stock Exchange platform, okay, your statutory charges, your exchange TO fees, except your brokerage and GST on brokerage, okay, it is 82 rupees, 82.80, 83 rupees, let's say, right? When you trade 100 lots. Now, please do remember, I have considered the premium as 1 out here. Usually the premium is, when you check 50, 55 paise. So there will be a further reduction in your total cost because everything is based on your exposure and which is being calculated using premium amounts. Okay, premium amounts. Okay, right? Wherein if you start trading futures, same thing, 100 lots, same thing, 100 lots out here. Okay, your statutory expenses and the exchange charges, right? Okay, will be 174 rupees approximately. Again, on both the sides, the brokerages are not included. My request to all of you, see, this is very, very effective. Let me tell you, if I change the example of currency option to 50 paisa, the grand total of currency option expenses comes down to 45, 48 rupees, even less than that sometimes. Okay. And we all understand that currency options specifically, from the brokerage perspective, are extremely available with a lot of leverage. So even the brokerage is very much leveraged on currency options on the number of lot basis, the market practice, or the number of orders. I'm not a party to make a comment on, but yes, it is more effective from the brokerage perspective. So it is, currency options are effective from brokerage perspective. Currency options are effective from the total perspective of the statutory and the exchange TO charges per se, when I'm comparing it with currency futures. Okay, right? That makes currency option further more effective leverage for your position creations. Okay, now the question is, can I replace my futures trading with options? Can I just say that, can I create a look-alike position of futures with options? Okay, yes, you can create that. In the world of finance, it is being called as synthetic positions, creating synthetic positions with options. Okay, now what are these positions? How to create them? Okay, I have a couple of slides for it. Okay, number 1, so far probably you might be creating a long futures position. Let me tell you, you are creating long futures position. Keep creating. Give an opportunity right, to the world of options as well. Probably an options position, which will exactly a lookalike position of futures, maybe more effective, maybe more effective. Let's compare this and let's understand this. So how to create a long futures with options? So what you need to do is you need to create two positions. You need to create two positions simultaneously. Do remember, simultaneously it has to be created. A lot of people makes mistake. They put a lag between the order execution. So it has to be created simultaneously. The least gap, it's an electronic world where we live in. Orders can be placed very, very quickly. Okay, so you have to create very quickly both the positions. What are these positions? So if the at the money option is trading at 80, right? Let's say if the futures is trading at 80, the at the money becomes 80 USD. Another example I'm taking up, buy a call, right, of at the money option and immediately sell a put option. Buy a call and sell a put option. Which strike of call? 80. Which strike of put? 80. Take same strikes, buy a call and sell a put. Let me tell you, by buying the call and selling the put, it creates exactly a long futures position. And it is called as synthetic long futures position. You're creating two positions simultaneously, right? Why? Because you understand that option trading is more effective. You understand the expenses associated with trading, right, in options is far, far less than futures contract. Okay, and we'll in next few minutes we are going to make it more effective as well in terms of pricing. Okay, number two is if you want to create a short futures position, same strike, let's say at the money, buy a put option and immediately sell a call option. Now the question comes up. Let me use some numbers. Okay, suppose I created long futures at 80. I bought a call at 50 paisa. I bought a call and immediately sold a put option at 50 paisa. If the premium paid against buying a call option and the premium received by selling a put option are same, okay, then my effective rate of creating a synthetic long futures position will be 80 only. But suppose I bought a call at 50 paisa, okay, at 50 paisa premium, I paid a premium, and I sold a put option at 53 paisa, right? Bought a call, sold a put, okay? But when I sold a put, I got more premium than the amount of premium paid for call option. I got 3 paisa extra, okay? This 3 paisa is going to work like, a best profitable scenario for me. Why? Because this 3 paisa will finally bring down my synthetic long futures position to 79.97. What is my strike price? 80. Okay, I got 3 paisa extra. This 3 paisa has to be deducted from the strike price. So what is my effective price of hedging with options? I created a long futures. Instead of creating a long futures, I created a long futures with options. When I did that, when the put option premiums were higher than call option premium, I compared it with futures. My position was at 80, 50 paisa paid, 53 paisa received. Extra 3 paisa reduces my price, the synthetic futures effective price per se of long futures. And how to calculate that? Take the strike price minus the extra premium received. And that is, so instead of futures, which is at 80, with options, I am able to create the same long futures, more effective from all perspective. And my long synthetic future position is at 79.97. I'm better than all by 3 paisa. What is the 3 paisa? The extra premium received while selling a put option. So the question always comes up, when to do it? Let me tell you, compare futures and options. Do it when your short put yields you more than what you're paying from the call option. And that is being written in next 2 lines per se. hedging becomes more effective when shorts are heavier than longs, when shorts are heavier than longs. The cost of hedging options is effective than futures, we all understand. Now, same with futures. Let me devote a couple of minutes on short futures position. Short futures, okay, suppose the futures is at at 80. Okay, if the futures contract is at 80, you can sell a futures at 80. Okay, but instead of that, you selected more effectiveness by creating option position, by creating an options position. Okay, what you did, you bought a put option by paying a premium of 50 paisa. You sold a call option at 50 paisa, same premium, bought, sold, same premium, right? In that case, your synthetic future position will be at 80. Your synthetic position will be at 80. Okay, but instead of this, if you created by buying a put option, you paid a premium of 50 paisa, and when you were selling a call, at that moment you received a premium of 55 paisa. 55 paisa. So when you're selling, you got 5 paisa extra. This 5 paisa helps you to improve on your synthetic short position. You got 5 paisa extra. This 5 paisa will work like strike price plus the net extra premium received is your effective price of hedging, right? So 80 is our strike price plus 50 paisa. That brings your effective synthetic short futures price, okay, at 80.05. So the question again comes up, when to do it? When everyone is doing at 80, I'm able to do it at 80.05. I got some extra paisas, okay, even 1, 2, 3, 4, 5, whatever, it is more effective. Sometimes even corporates who are doing this, they even do it just to get 1 paisa, 2 paisa, because for a huge position, even 1 paisa and 2 paisa is far more effective. Okay, and when to do it? Okay, when short call yields you more than the amount of premium going out of your pocket at the time of buying a put option. Okay, right? Okay, now this is just an payoff representation. Just to give you a context out here, I have taken same premium. Okay, this is long call, this is short put. Okay, people who understand options more from payoff diagram perspective, this creates exactly a position like futures, a long futures. Same way for short futures, buy a put option, sell a call option out here. This will be exactly equal to a short futures position, exactly like a short futures position. Okay, start using it. This is much more effective than everything else. Okay, even sometimes people creates if the futures is at 80, they even create a synthetic at 80. Why? Because on the other side, the expenses, the trading expenses related to this are comparatively lesser than futures. Okay, do remember, in synthetic position, whether you are creating a long synthetic or a short synthetic position, margins are required, definitely. Why? Because ultimately one leg of your position is short in nature, so you require margins. Okay, some pointers related to synthetic positions when you are creating. This is my personal experience. You need to check the risk policy document of your company, right? Why? Because usually there are restrictions in terms of short position when you create. Okay, if there is a restriction, you may approach right authorities, change it, and start using it. Selection of strike will increase probability to win against the odds. That's again a very, very important perspective. You have to select a right strike price. Synthetics are usually effective on at the money options. And do remember, when you're creating 2 positions simultaneously for synthetic, you have to square off both of them simultaneously, and it can be squared off at any given point in time. Okay, these are 3 important points which I thought to highlight it to. Right, apart from this, how options can add value in your hedging. When you are hedging your physical exposure, how options can add value. So there are several things which are being executed these days by market participants. I have tried dividing them in 4 different verticals. Number one, single leg option hedging. Okay, single leg option hedging means against your physical exposure. Buying a call option, buying a put option, which we understood. So write a call option, write a put option. Okay, you can do this. But do remember, when you're writing options, you need to understand the risk associated when you're selling option contracts, right? Understand the risk associated. If you're connected with any SEBI registered investment advisor, if you have your own research team, understand the dynamics related to writing naked options contract. Consider risk, manage that risk, and then start using options. Okay. You may also use covered and protective strategies, right? If you're already using futures, suppose you're using futures contract and you want to reduce your risk. If you want to reduce your risk, there are strategies. But when it comes to protective and covered strategies, you are trying to combine, please mark it, you're trying to combine a futures position with options. Your objective is to protect yourself, or you want to reduce your cost. We'll understand covered call option in the next few minutes, but yes, two perspectives can be understood. The word protective itself says your intention is to protect your futures position so that it should not go haywire. Or if you're using any kind of covered option strategies, okay, you want to reduce your cost, right? Reduce your cost. The third vertical largely talks about spreads. One of the finest thing which any corporate can use and start implementing immediately, right? Understand the dynamics which we are going to, discuss now. Okay. But yes, spreads. Spreads are also called as defined risk strategy. So at the time of initiating a spread, a bull call spread or a bear put spread, okay, you will be able to find out your maximum negative, your maximum positive. Amazing thing. Think about it. You define both the sides. With spreads, you define both the sides, your maximum loss, your maximum profits. Okay. We'll discuss with numbers per se. Okay. The combination out here, the combination strategy like Siegel, range forwards, okay, and many more are also being available. Okay. We'll understand step by step. It's really not possible to cover each and every perspective of strategies, but we'll try to give you some glimpse of each and every part per se. Okay. Now it is also important to understand when and how options to be used while hedging. So when you're hedging, okay, how to use options. Okay. Number one, let's discuss first about long side. When a strong move is expected in any of the direction, you should use the long side of the options contract. So you should go long. So when you're expecting a strong move, could be in either of the direction I'm trying to say, you can use the appropriate long option positions to hedge. Okay. Number two, when you don't want to miss a market opportunity, okay, when you see a market opportunity of a movement happening due to some news data release, okay, in such cases, if that is going to hurt you, if that movement, if that news is expected to hurt you, when you don't want to miss a market opportunity, you should use the long side of options. Okay. And when you want to lock in price along with your preference to decide on exercise on expiration date, again, you should use the long side. That's nothing but a technical sentence being put up. It is nothing but what we understood, that if you go and buy a buy a call option or buy a put option, you're trying to lock in your prices, exchange rates. As far as short option side is concerned, when you want to reduce the cost of buying lag in the option, usually when people buy options, to reduce the cost, the amount of premium being paid, to reduce that, people use short side of option. Yes, appropriate and has to be used. Okay, but after considering the risk associated. When you expect the underlying market will remain in consolidation, that is nothing but in a range. when you are not expecting any major news, data release, interest rate change, uh, some global news, nothing. And also when the exchange rates are in consolidation, right? It is more appropriate to use short side of options. Okay. And third, when you want to receive premiums, which reduces your overall cost, right? These are three long side scenarios. When to use long side of options, short, three more scenarios. Okay. You have to use very appropriately. It is ultimately your decision, right, to go long and side. But my perspective of putting this slide is to give you some understanding, right, that when options can help you to leverage your effective rate of hedging. Okay, that's what it is being put on. Okay, now moving on to defined risk reward strategy spreads. As I've told you, we are going to discuss something about bull call spread, which is extensively being used by importers, right? It is being created by buying a call option, okay, of a near strike and selling a call option of a higher strike. Okay, it defines the risk level associated, the maximum risk associated to this strategy. It also defines the maximum reward which you can get out of the bull call spread, and that's why it is called as defined risk strategy. Okay, so for this, let me use a quick Excel sheet. Let me use my quick Excel sheet to explain this with numbers. Numbers are always more effective in options world. I hope my screen is visible. Let me increase the font size quickly. Okay, so what we are actually understanding is bull call spread. Okay, a quick calculation, 2 minutes, and your bull call spread you'll be able to start implementing immediately. Okay, let's say buy a call options contract. Okay, let's say strike is 80. Okay, and premium is 0.25. Premium paid. Okay, let me write premium paid. Okay, as an importer, quite effective for you, right? And you also sell a call options contract. Okay, now you sell this at 80.50. Okay, and you will receive a premium receive a premium, let's say 0.05. Okay, 2 strikes has to be used. Okay, a usual question comes up that why I'm selecting 80 and 80.5, right? Let me tell you, 80 is at the money options contract in my example, and 80.5 is the expectation that exchange rate can move up to 80.5. If the expectations talks about 81, then the selection of strike price for call options contract will be 81. Okay, so let's quickly calculate now. What is my net premium? Net premium paid. Okay, I paid 25 paise, but I received 5 paise. My net premium paid is 20 paisa per se. Okay, my net premium paid is 20 paisa. Okay, what can be my maximum loss? Because the name itself suggests it's a bull call spread. You're bullish, you're using call option, and your position is staggered, is being spread out in 2 different strike prices. My max loss, right, is also being defined that if this is being created with an expectation of bullish sentiments. Okay, bullish sentiments, but suppose if the INR starts appreciating throughout the month, in that case, I will have a loss. My maximum loss is nothing but the net premium paid. My max profit, when I'll be going to have maximum profit out of this position. Okay, quite simple. Okay, my maximum profit will happen when the exchange rate, the spot exchange rate goes to 80.5, which is nothing but the strike price which I have sold. Because that was my expectation, that it may reach up to, the exchange rate may reach up to 80.5. Okay, my max profit is also being defined. Very, very simple. Have a look at it. 80.5 minus 80, right? The difference in two strike to be taken up minus the maximum loss. So from day one, you are aware of that I can have a maximum profit of 30 paisa, and my worst case scenario will be 20 paisa, right? And my max profit point, right? That means when I'm going to have my max profit on the date of expiration, right? And I will be having my maximum profit at 80.5. So when the spot rate, exchange rate on the date of expiry reaches up to 80.5, that is the point wherein I'm going to have my maximum profit, right? As per expiration day payoff. Okay, right? One more thing which you need to understand, that where is the break-even point in this, right? And anything going beyond that will start yielding profits in this strategy, right? Okay, profit from strategy, you can combine this with the underlying exposure. So 80, which is your lower strike price, minus, I'm so sorry, plus the max loss, which can happen to you. And that is your break-even point. So at any given point in time, if the exchange rate goes beyond 80.2 on the date of expiration, right, 80.2 will work as a break-even point for you, right? So simple. Take two strikes, take two premium. The difference of premium is the maximum loss. Difference in strikes minus difference in premium, okay, is maximum profit per se. Break-even point, the higher strike price, and the lower strike price plus the net premium paid, and the maximum profit point is the higher strike price. Same way you can do it for bear put spread, because time is limited. Bear put spread, okay, at the money options to be bought, out of money options to be sold. Same formula, premium paid, premium received, difference, and everything remains. Let me tell you, everything fundamentally remains. But that is being extensively used by exporters. So if you're an importer, right, along with your underlying exposure, you can combine a bull call spread. Do remember, creating a bull call spread requires margins. Okay, but yes, benefit of margins, you will get, because you are long, you're short in the same series per se of options. Okay, so a bull call spread and a bear put spread. Market, it's a defined risk strategy. Okay, works quite good. Okay, going to covered call. So with a long futures, when you want to reduce your price, effective rate per se, what you can do is with long futures, when you combine this with a short call option, right? And it helps importers per se. It helps in reducing the cost. And a bull call option attempts to enhance the return. The objective is to enhance the return in a stagnant market or in a range bound market. But do remember, before doing this, you should have an understanding, all volatility days are over. We are not expecting much of volatility, though the USD INR exchange rate will be in a range. Could be a broader range, but still you can use that information and create a covered call. Do remember, there are tools available in the market which even tells you, okay, whether markets currently are in consolidation or in trend, right? There are statistical, technical tools being available in the market which even tells you, whether the consolidation phase is going on or a range-based markets are prevailing. Okay, the current conditions per se. Okay, couple of last slides from my side, particularly talking about, because there are a lot of strategies, but which strategy to use when. Okay, so if you are an importer, you can use a covered call strategy. It helps you to get an additional income per se. But the disadvantage to it is it works good only in a stable market. A little positive and a stable market is the problem. Okay. Bull call spread. Okay. It's good for importers per se. Limited profit, limited loss strategy, the defined risk, defined return strategy. However, the time value, if you hold this for a long period and there is not much of movement per se in the underlying, or it is going against your expectations, the time value erodes the profits. Okay. A bear put spread is good for exporters. Again, limited profit, limited loss strategy. Time value, the more you are going to hold it, right, more it hurts you in terms of time value of the options contract. Okay. Time value is being associated with the premium amount, right? And it has a tendency to get eroded from the premiums. So when you have a long position per se, or a net long position, it always hurts you. A bear call and a bear call spread and bull put spread, right? The advantage of creating this are time value, right? But do remember, these are two very, very risky strategies. Okay. But the time value keeps helping you in terms of the more number of days when you hold it. Please do remember these two strategies, bear call spread and the bull put spread. The disadvantage is risk reward ratio is not favorable. And that's why you will not find much of, or many of people actually, discuss about this strategy, or much of people use this strategy per se. Okay. A long seagull and a short seagull is being put about here. Again, two popular strategies per se. A call debit spread combined with premiums. A call debit spread, which is nothing but a bull call spread plus a put option being sold. A bull call spread you create, which we understood, right? And you're also selling a put option. A bull call spread is a bullish strategy, and you're also selling a put option. That means it's a directional strategy per se. Directional strategy. So the advantage is, if the direction is what you predicted, forecasted, thought of, whatever, then, right? If it works good, it is going to give advantages. If not, then short option position has unlimited risk. Okay, you went short with the put option. A short option position has unlimited risk. Same for short seagull. A put debit spread combined with premium received from call option to net of premium paid. And short option position has unlimited risk. The objective is number one, okay, that you should know synthetics. You should know different type of strategies which are applicable and available. Okay. Our objective is to give you a thought that how market participants understand options, how corporates can use it for a better effective rate of hedging, to achieve a better effective rate of hedging. Though there are I believe more than 200 strategies and options. Okay, the name itself is options, so you have many options to execute, from calendar spreads to iron condor strategies, kind of 4 lakh, 5 lakh, 6 lakh strategies, adjustments and everything, which you can always use. My last point out here, and then we'll move to Q&A session per se, is that, and sorry for using a Hindi language, I believe there are a lot of people being connected from southern part of the country as well. Options is like chakravyuh. Option जो है वो चक्रव्यूह की तरह है. आपको अंदर जाना भी आना चाहिए, लड़ाई करना भी आना चाहिए, और बाहर आना भी आना चाहिए. That means you should know, you should have skills, you should have a thorough knowledge of when and how to make an entry in an options position. You should know the exit, the point of exits. And number 3, you should also know that when you are in trade, and if adjustments are required, how to deal with those adjustments, right? So when you create an options position, you should know entry, adjustments when it goes, against your expectations, and the exits. All 3 perspectives are important. Okay. understand, learn all three perspectives. The biggest problem which I see is that people know how to enter, but they don't know the adjustments and exits. There are people who know, who understands, who knows that yes, this is the where I have to make an entry with the options, and this is my point of exit, but they are not aware of the adjustments. So understand adjustments as well. Okay, right? That's the end of my part, and thank you so much. Back to Divya for Q&A.
Thank you, Hitesh, for the wonderful presentation and the knowledge shared with all of us here. We have certain questions, and we would like to go ahead with the Q&A session now. So over to you, Hitesh. What are the various tools available that can be applied before the hedging strategy?
Okay. So out here, tools for hedging per se. Let me define those tools which are available in the markets, which needs to be understood by everyone before they enter with their underlying exposure in the options market. Okay, that's the question, right?
Yeah.
So for options, okay, Greeks is the final tool which needs to be understood. Option Greeks needs to be understood by everyone. Okay, right? And particularly two perspectives, right? Two perspectives. Number one, which is understanding gamma, because most of the people actually just run through the delta and all, but you should understand the word gamma. Okay, it has a direct impact on your portfolio, right? The way people talk about delta neutral, people even do it gamma neutral position. I really don't want to get into it. Number one, people need to understand gamma. Number two is a combination of 2 points of Greeks, which is really being ignored by a lot of people. And people need to understand these two perspectives. Theta, which is time value erosion, which happens, and vega, which is volatility. Now, let me tell you, Divya, in my experience per se, most of the people these days understand theta, that okay, when they buy a call option, the value of premium keeps eroding. But, and this is how we have been taught as well, that okay, a change in underlying will impact the delta, and accordingly the premiums will move. Okay, but the tool is volatility. There is a proverb in the world of options market that new traders trades on premium, wherein corporates and intelligent investors invest on volatility. Now, this is nothing but volatility of options, which is defined as implied volatility. I can give you an example. That there could be a 16% impact. A 16% impact on the premium is just because of change in volatility by 1%. That means if you change if the volatility of options, the implied volatility of option changes, okay, it can have an impact of 16% on the premium. Now think about it for a second. A 16% change in premium, right, it can have an impact on premium, can change your entire trade-off. But unfortunately, it is being ignored. It is just being considered option these days. The moment it is an option, is just being considered as okay. If the exchange rate moves, the call premium will move. If exchange rate goes down, the put premium will go up. That's it. No, let me tell you, volatility has much more important than all other factors, particularly for corporates who wants to hedge it for a little longer period, not for the immediate Friday expiry, but want to use it for near or next month expiry contract. For them, they need to understand the volatility. So the tool is nothing but the option Greeks. A good grip on Greeks, option Greeks, can help people to make better trade-off against their underlying exposure for hedging.
So over to the next question. Can we adjust the single leg after taking position in cost reduction strategy for one exposure?
So people who are learning first time about cost reduction strategies like bull call spread, bear put spreads, for them, I won't advise per se, but yes, if you understand how during the tenure of your strategy, see what we understood is the profit, loss, break-even point on the expiration date. But during the tenure of your strategy, right, if it is not profitable, yes, you can adjust, but it completely depends. When you do adjustments, you should have a view per se. Without a view, you can't make an adjustment. A view could be anything. A view could be my position is not profitable in a bull call spread. Why? Because I've selected a wrong strike. Okay, that is allowed. Most of the time, the adjustment happens in the selling side of option. Now, please mark my words, and everyone who's listening to me. Adjustments are always being required on the second leg, which is the selling leg, right? Because the profit losses are much more dependent on your selling leg. Go and make a chart. My request to all the participants who are listening, make a chart, take different scenarios that if the price moves up by 10 paisa, 5 paisa, and during the course of the tenure of the contract, not on the expiration date, because adjustments are required to be done during the tenure. So that needs to be done. But adjustment of selling leg is much more important and evident.
Next is, what could be the best possible adjustment in straddle strategy in currency?
Okay, so long straddle, my advice is that if it is not working good for you, simply get out of it. A long straddle at the money options contract with Greeks, it says it can hurt you if you hold a position for a longer period. But for short option position, definitely, though time is limited, so I will directly use the name of the strategy for a short straddle position, short straddle position, right? Change it to different strikes and try to create an iron condor position with it. That is more effective.
How can longer tenure, more than 3 months exposure covered, using options as premiums are too expensive?
I missed it.
How can longer tenure options, more than 3 months exposure cover, using options as premiums are too expensive?
Oh, this word, which is expensive, Divya, let me tell you, is one of the most crucial words in the options. The problem which I see is when people just start comparing premiums, right? Comparing premiums is not appropriate in options. It is comparing volatility levels per se. So what I'll do is I'll take a couple of minutes for this because this is extremely important. I believe all our corporate friends who are, are already associated with us, and the friends who are going to be associated with us have this challenge per se. Okay, so what I'll do is I'll explain this with a quick example. Okay, so I'll do a screen sharing again with this. Okay. Okay. So I'm using a portal. I'm not promoting them, but I'm just putting an example with that portal so that everyone can understand the perspective to it. Okay. It's option-price.com. It's an option calculator. Okay. And let me use an example. Suppose the underlying price is at 80 USD I'm talking about. Exercise price 80. Let's say 60 days remaining for expiration. 2 months contracts, because your example talks about 2 months, 3 months contract, which people talks about that they're more expensive. Okay, they need to understand what is expensive and what is not premiums. Okay, let me remove the interest rates because I consider underlying as my futures contract. So NSE USD futures contract I'm taking up as my underlying price. sorry, and the volatility is 6.5% I'm taking up, which is the current volatility prevailing in the market. If these are the parameters, okay, it says that my premium for a call option, when the volatility is 6.5%, implied volatility is 6.5% for a 2-month contract, my at the money options contract, all right, might be trading very, very, very close to 0.84. 84 paisa will be the premium. Now, so people, what they start looking at, oh, 84 paisa is expensive. Yes, no, or maybe. Let me tell you, right? Let me tell you. Instead of this 84 paisa, have a look at it. If the volatility, right? Volatility would have been 5.5%, a 1% less in volatility might be prevailing in the market. Okay. The same option will be available to you at 71 paisa, 84 paisa and 71 paisa, a 13 paisa change, right? When the volatility is being changed by 1%, 13 paisa change when the volatility changes by 1%. So don't you think it is more appropriate to start using this information to start valuing the option or pricing the options, saying whether it is expensive or not? Let me repeat, or sorry, let me clarify this further. Lesser the volatility, implied volatility, the option is considered as cheap, not based on premiums, okay, right? And higher the volatility, it is considered as expensive. Okay. And what I was trying to say even in the previous question, okay, that yes, the volatility, if you see this out here, it is 0.129, right? The Vega value. Sorry, I'm not teaching you anything which is very comprehensive, very, this thing, but just last one point out here as in Vega. It says if 1% change in volatility happens, what will be the impact on premium? So 1% out here is equals to 13 paisa premium, right? Your premium can be higher, your premium can be lower. How to decide whether it is expensive? Based on the prevailing volatility rates. And if I put that in the context of calculation per se, right, I can get cheaper premiums if the volatility is 5.5. Just an example, right? And if the volatility is 7.5, 8.5, 9.5, I will call it as expensive premiums. And a 13 paisa change on 84 paisa, 13 paisa change, 1% change in volatility is equals to 13 paisa in an example, the Vega value, and the premium is 84 paisa, right? 13 by 84 into 100, it says, see, 15.5%. 1% change in premium, 1% can change in premium, can change your perspective of premium being expensive or premium being a cheap person. So my request to all, start tracking implied volatility rather than just the premium.
Hitesh, one last question to be covered. Difference between futures and options initial margin.
Okay, so approximately same, but the advantage is when you sell an options contract, you receive premium, and that received premium actually reduces your liability of the total premium being paid against a short position. So suppose if 2,500 is the futures options premium, okay, right? And if I receive, let's say 300 rupees out of my position, okay, this 300 is going to reduce my net exposure of margins per se. That will bring it down to 2,200 rupees. So instead of 2,500, 2,200.
So Hitesh, so due to time constraint, we'll end up the Q&A session here. And now I would like to introduce and invite Mr. Tojo Banerjee for the vote of thanks. Mr. Banerjee is Vice President at NSE, National Stock Exchange of India Limited, and heading the international and domestic institutional business at the exchange. Toja sir, over to you.
Thanks, Divya. Uh, Good evening, everyone. I think you are enlightened on the options part after a very good presentation given by Hitesh. Thanks, Hitesh, for the wonderful presentation. I hope it will help all our corporates to make a correct decision about moving to options. My big thanks to all the participants. And it was a nice thing that some 420 people have attended this webinar, which is not a small number. And I hope the intention with which we did this webinar, because initially when like what Hari told, we are in exchange futures business from currency futures business from 2008, and 2010 we launched our options. So corporates who were always there in our futures currency business was always concentrated more in the futures business. But last 1 to 2 years, we are seeing that the corporates are showing interest in the options business also. And I can, Hari also has shared, the last 2 years, we have seen a tremendous growth in the options volume in the currency also, because in equity options, India is growing very fast, and the currency option is also not behind. So it was, we thought it was a good time that we also bring in some knowledge sharing sessions for you all to have a greater idea about options. I know many of you are using it, but if after this session it helps others to start, it will be great. I will not take any further time. I thank all of you for attending this webinar. Please get back to us for anything you need regarding any of the queries you have. We will be very happy to help you out. And I hope Vivek, Divya, and our whole corporate team across the regions will always be available to help you with all queries. And if you like it, let us know. We can hold such similar kind of seminars for different topics as you want. Thank you very much for attending the session.
Thank you, Toja sir. So here we end this presentation, and thanks to all the participants. Thanks to all the the speakers, Hitesh and everyone. Thank you so much.